financial performance, assessing corporate performance. So this is also another area that is sometimes examined, assess how to assess the corporate performance. When it comes to assessing corporate performance, the key technique in assessing corporate performance is ratio analysis. So what you need to do is to calculate the ratios, and then from that calculation of ratios, you can make an interpretation. So the key technique, the key technique use it in assessing corporate performance is ratio analysis. And you can say that ratios can be analyzed either using a trend Now, when we are analyzing ratios, you can analyze them either using a trend analysis or using what we call an industry analysis. Now, if you go to trend analysis, so in trend analysis, what you do is to compare the current performance to the previous performance, and then come up to identify whether there is an increase or a decrease in the item or in the performance. That is the trend analysis. So we can say that this involves comparing the current performance to the previous performance in order to establish an increase or a decrease in the performance. That is what you do in a trend analysis. You compare the current performance to the previous performance. The important aspect in the trend analysis is to find out if there is an increase or a decrease in performance. Oh. Let me open the microphone. Members are complaining that they are not hearing me. I don't know. Do you hear me? The microphones are open.
Yes, sir. We can hear you.
Yes, we can hear.
Loud and clear.
Then others are saying that they can't hear me. I don't know.
Maybe it's a network.
So that is the trend analysis. Then another one is what we call industry analysis. So in industry analysis, what you do, you compare the company's performance to the other companies in the industry. For example, if it's university, you compare maybe University of Kigali with other universities in that industry of a university. So that is what we call the industrial analysis. You compare the performance of the company with other companies in the industry. So let's look at the types of ratios. Types of ratios. Now, ratios can be classified into 5 major categories. It depends on what you want to measure. The first ratio we are going to talk about is profitability ratios. Profitability ratios. Profitability ratios, what you are measuring, whether the company is generating enough profit. That's the interest you want to find out. Is the company generating enough profit from operation or not? Then you are going to compute the profitability ratios. So you can say that this is used to assess whether the company is generating enough profits from operations. What you are doing here is to assess whether the company is earning or generating enough profit from its operations. Then you are going to compute the profitability ratios. So the key ratios that are used, we have the gross profit margin, that is the number one, gross profit margin. The gross profit margin, it measures whether the contribution earned on sales, on every sale the company makes. On every sale you make, what contribution do you make or do you earn? What you want to assess here, how the company is measuring or how the company is controlling its variable cost. This measures the contribution earned on every I don't know if it is my internet. The internet is not stable. I don't know because it is of rain, but it seems the internet is not stable. So that's how we get the gross profit margin. Then number two, we have the net profit margin. Net profit margin. So the net profit margin, it measures the net profit earned on sales. So what you are interested to look at, after paying the expenses, how much profit do you earn on sales after you have paid or after the company has paid all its expenses? So this measures the profit earned on sales after pay today the internet is very bad. Then time was 100, it has gone again. So that is how we get the net profit. The net profit margin. I think the rain has affected our internet. Then number 3 is what we call return on capital. Capital employed. Return on capital employed. So the return on capital employed is used to assess the borrowing capacity of the entity. What you are looking at, whether the profit earned from your operation can pay the borrowing costs. That's the return on capital employed. Do you generate enough profit from your operation to pay the borrowing cost or the cost of capital? So this assesses whether the profit earned from operations can pay the borrowing costs. That is what you are looking at on return on capital employed. You are comparing your borrowing cost or your cost of capital in relation to the profit you are earning from your operations. So when we are computing, our return on capital employed is equal to profit before interest and tax, profit before interest and tax times 100 the net profit, that is profit after tax, not profit before tax, the net profit after tax, after you have removed the tax. Divided by capital employed. So that is the net profit, return on capital employed. And to get capital employed is equal to total assets minus the current liabilities, or total equity plus non-current liability. So as we have already said, in this ratio, your interest is to show how much, whether the profit you are earning can be able to pay your interest or your borrowing costs. Then another one we have is that is D, return on assets. So return on asset. This measures the return generated on every investment. Please, today the network will have to move slowly with it. It is very up and down. Yes, I think it can be the net asset. The network is up and down. So we have to move slowly with it. So that is the return on capital employed. Then we also have what called the return on equity. Return on equity. The return on equity just shows how much return do you earn on equity investment. So this ratio is also used to assess whether the management are managing the organization well or they are not managing the organization well by looking at the return they are generating on the shareholders' equity funds. So this measures the return generated on the equity investment. How much profit do you earn on every equity investment? So when you are computing the return on equity, it is equal to net profit over total equity. So for these ratios, these ones, the higher the ratio, the higher the ratio, the better the performance. The higher the ratio, the better the performance. If the ratio is high, it indicates a high performance. If the ratio is low, then it may indicate a decrease in the performance. So that is the profitability ratio. So another type of ratio, which is number 2, is the liquidity ratio. Liquidity ratios. So the liquidity ratios, they are just used to assess whether the company has enough liquid to pay its obligations. Suppose you are supposed to pay your obligation. Do you have the cash to be able to pay those obligations? Then in that case, you're going to assess liquidity. So if you are assessing whether the company is facing challenges to pay the obligations, then in that case, one of the key ratios you are going to assess to look at are the liquidity. So these are used to assess whether the company has enough liquid asset to pay the current obligations. So what you are doing here, you are comparing your liquid assets, those assets that can be liquidated easily, and then you look at the current obligations. Do you have those assets to be able to pay those obligations? So as we discussed in working capital, the key ratios that we're going to use, number one is the current ratio. And so this assesses whether the entity has enough current assets to pay the current obligations. So when you are looking at current ratio, you are interested to find whether you have enough current assets to be able to pay the current obligations. So here, our current ratio is equal to current assets divided by the current liabilities. The answer here is given times. You are looking at the number of times your current assets can pay the current liability. So as we discussed in a working capital, this ratio should not be, it should be 2 to 1, in that range, 2 to 1. I think we talked about that. Then another ratio which we use here is what we call the quick ratio or the acid test. Quick or acid test. The acid test ratio. The quick ratio, or what called the acid test ratio, it measures the ability of the entity to pay its current obligation without relying on stock. Suppose you have not sold the stock. Do you have the capacity to pay the current obligations? Because as we said in working capital, some businesses have got a low turnover of stock. So you are looking at, in cases where stock has not been sold, whether the entity can pay its current obligation. And say this measures the ability of the entity to pay the current obligations without relying on stock. That is, in case you have not sold the stock, or in case the business has not sold the stock, is it in a position to pay the current obligations, or it's not in a position to pay the current obligations? Galaxy 12. What is wrong? So that is and our quick ratio is equal to current assets minus stock, then divided by current liabilities. So even here, you give your answer in times. The number of times your current assets can pay the current liabilities without relying on stock. So that is how we measure liquidity. Another type of ratio, that's number 3, activity or efficiency ratios. So the activity or efficiency ratio, they measure how organizational resources are managed. The working capital, the assets, how does the company manage its resources? So this is used to assess the efficacy of managers in managing how managers are managing the organizational resources, the working capital, the assets. Then you are going to measure the activity or the efficiency ratio. So the key ratios that we use here, number 1, we have the debtors turnover, debtors or receivable. I think we talked about this one in working capital or receivable turnover. I think we talked about this, shows the number of times or days receivables are turned into cash. In other words, how long do you take to collect from your customers? How many times do you collect from your customers? In that case, you're going to calculate the receivable turnover. We saw this one in working capital, so I can just only provide one formula here. Our debtors turnover we said is credit sales divided by average debtors. And under this, as we said in working capital, you are giving the answer in times, the number of times you are converting your receivables into sales, into cash. Remember, we also looked at the number of days. You just converted the formula as we saw in our previous discussion. Then in number 2, we have the inventory turnover. this measures the number of times inventory are turned into sales, or the number of days it takes to sell inventory. That is the inventory turnover. You are looking how many times do you convert your inventory into sales, or how many days do you take to sell the inventory. Of course, as we said, the more the number of times, the better the performance. The fewer the number of days, the better the performance. So in this case, when we're computing the inventory turnover, it is cost of sales over average inventory. So you can convert the formula and then make it in days. We discussed those ones in our working capital, and here the answer is in times. The number of times, if you make average inventory over cost of sales, then it becomes 365. As we saw in the working capital, it becomes days. Then number 3, we have what called the payable turnover. The payable turnover. Payable turnover, you are measuring the number of times payables or suppliers are paid. How long do you take to pay the suppliers, or how many times do you pay the supplier in a given period? That is the payable turnover. So this shows the number of times the suppliers are paid in a given period. So if it is within a given period, how long do you take to pay the suppliers? But I think we talked about these ones in the inventory. Even here, if you want to put the answer in days, it is average debtors divided by credit sales. Then times 365. I think we saw these ones. In this case, the answer is in days. Here it will be average inventory over cost of sales times 365. And here the answer will be also in days. I don't know if I've answered you, someone who was asking this, but we saw these ones in working capital. I'm just repeating the same thing, but we have already seen these ratios in working capital. Then we are looking at the payable turnover, and we said it just shows the number of times your payables are converted into are paid. So when you are computing the payable turnover, our payable turnover is equal to our credit purchase divided by average payables. And here the answer is in times. If you want to put them in days, it will be average payable over credit purchases. So in that case, you are going to give your answer in days. Average, of course, you are getting opening plus closing. If I'm analyzing 2 years, 2015 and 2014, if I'm analyzing these 2 years, so it means, let's say I can extend it there a bit. Let's say I have data here of 20 and I have data here of 30. So if I'm analyzing in 2014, I will not divide this because I don't have the opening. I will take this one as my average data. But when I'm analyzing for 2015, I will get 20 plus 30. Then I divide by 2. I get the average. I hope I've answered you. It's the same with inventory. It's the same with payables. The last one I can talk about here is what we call the asset turnover. The asset turnover. So we can say that this shows the number of times assets generate. It shows the number of times assets generate sales. How many times do your asset generate sales in a given period? So when you are computing your asset turnover, it will be equal to sales divided by your total assets. You can as well put this one into percentage by getting total assets over sales. So this answer should be in times. So these are what we refer to as activity ratios or efficiency ratios, which is our category number 3, sorry. Then category number 4 of the ratio is what we call gearing or leverage. gearing or leverage ratios. Now, the gearing or leverage ratios, they are used to assess the proportion of debt to equity and the level of debt or the level of debt within the capital structure. And also to assess whether the business is solvent or not solvent. Then you're going to use gearing. So if you find that maybe the shareholders are wondering about this, the solvency of the business or the level of the debt, then in that case, you need to assess the gearing of the gearing level of the business. So these are used to assess the level of debt in the capital structure or the solvency of the business. So in gearing, you are assessing the level of debt, what's the proportion of debt to equity within the capital structure, or you can use these ratios to assess the solvency of the business. So the key ratios that we use to assess this one, number one is debt to equity. This shows the proportion of debt in the capital structure. So in your capital structure, what is the proportion of debt, or what is the percentage of debt in relation to equity? So when you're getting the debt to equity, it is equal to debt divided by equity. So that is how you can assess. Then the second one is the debt ratio. The debt ratio. The debt ratio, it shows the relationship between your assets and your liabilities, or between your assets and your debt. The issue here, you are analyzing whether the business has enough assets to pay the debt. Do you have enough assets to pay your debt? Then in that case, you're going to assess the debt ratio. This analyzes whether the firm has enough assets to pay the debt or the total liabilities. So you are looking at your debt and your total and your assets, whether the business has got enough assets to pay those liabilities. So this one is also the one that checks whether the business is leveraged or not leveraged, based on what is the percentage of assets, what is the percentage of debt to the total assets. So when you're getting the debt ratio, it is equal to debt over total assets, or we can get our total liabilities divided by our total assets. Of course, this ratio should be below 1. Then another ratio which we use to assess, that is C, we call it interest cover. Interest cover, sometimes we call it interest earning ratio. Interest earning ratio, it means the same. Interest cover, interest earning ratio, it assesses the same issue. So this is used to assess whether the number of times the profit generated from the operations can pay the interest expenses. So in this case, you are going to what you are looking at, how many times the profit you generate from your operations can be used to pay the interest expense. So when we are computing our interest cover, it is equal to earning before interest and tax, earnings before interest and tax, then divided by the interest expense. So the answer here is also given in times. The number of times you are earning before interest and tax can pay the interest expense. So that is how we assess the gearing of the business. The next one, that is category number 5, which is our last category, is what called the market, or sometimes we call it the investors ratio. So the investors ratio are used to assess the company's image in the market. In other words, how do other investors look at the company or value the company? In that case, you are going to assess the investors, you're going to use the investors ratios. So this is used to assess the image or value of the company in the marketplace. It is mainly used by investors if they want to assess the value of the company at marketplace. So the key ratios that we use, number 1, we have the earnings per share, earnings per share. So this shows the return or profit generated on each share investment. How much profit do you earn on each share investment? What is the profit you have earned in a given period of time as far as each share investment is concerned? So if you are computing your EPS, it is equal to profit attributable capital to ordinary shareholders. Then divided by the number of shares. I think we've already looked at this in our previous discussion. So here it is you are giving it the money, it is in profit. That is in the unit of measurement is the currency. The money you are getting, that is the unit of measurement in this case. Another one which we have already also looked at is the price earning ratio. Price earnings ratio. This shows the profit, the relationship between earnings per share and the profit. So and the price, sorry, and the price per share. So what you are assessing is in relation to the company's profit. So in the company's earnings, how are the shares priced? Are they overpriced or are they underpriced? I think we have been using this in our previous discussions. So when we are computing our PE, we said it is a price per share divided by the EPS. This one is just a ratio. Another one is the dividend per share. So that is it shows the distribution and it shows the distribution and on each share. How much do you receive on each share investment? Then you are going to get the dividend per share. So when you are measuring, it's going to be DPS equal to dividend distributed divided by the number of shares. So the unit of measurement is also currency here. You are showing the currency. Last but not the least is the dividend yield. Dividend yield. That is the last, but not the, I can't say these are the only measures, but that's at least we can talk about these ones. Dividend yield. So dividend yield, as we discussed in our previous discussion, it just shows the relationship between the dividend per share and the price per share. So how much dividend do you earn? How much return do you earn on book value investment in shares? So this shows the return on the book value investment in shares. It shows the relationship between dividend per share and the price per share. So you are showing the relation between the dividend per share and the price per share. How much do you earn on every share investment as dividend? So when we are computing, our dy is equal to DPS, that's the dividend per share, divided by price per share. Then you can get your dy. So in a brief, these are different ratios which you can use to assess the cooperative performance. Now, if it's an exam, because in most cases, if it's an exam, it requires you to compute, and then after computing, you write a report. That is how questions are asked. You write at least a simple report, even if it is 1-page report, but it should be capturing the information that you have done. Now, when you are answering a question on this part, oh, this one I don't need to touch here. Probably I can use here. To illustrate this, I want to illustrate something here, that if you are answering a question on analysis, how do you handle that? That's what I want to show. Now, when you are answering a question on this part, you have here, you first draw a simple table. Then in your table, in the first column, show ratios. Here, show the formula you are going to use to calculate. Depending on what the question has asked, whether they are interested in certain information or they are interested in oral information, look at the question and see which information that is required in the case study. Now, if I'm answering here, if it is, I'm going to say profitability. I'm going to assess the profitability of the business. What are the key ratios in profitability? I have maybe the gross profit margin. I have the net profit margin. I have maybe the return on capital employed. And I have the return on asset. These are the ratios I'm going to compute. Then I show the formula here for that particular ratio. Then here I show my calculation, and maybe if there is an industrial ratio, I show the industrial ratio. Then after profitability, then I'm going to go to another ratio. Maybe I'm going to also look at the liquidity. What do I need to see in liquidity? Today the internet is really bad. It is on and off. Then I'm through with my activity. I show the, as I was saying, I will show the formula here, and then I show my calculations. Then I can go to gearing and so forth and so on. What do I need to see in the gearing? I need to see the debt to equity. Maybe I need to see the debt ratio and others. Then after showing this, depending on what the question requires me to do, I do my calculation. Then the next step is to write a report. Writing a report. When you're writing a report, you are interpreting the data you have already calculated here. So your report shouldn't be very big, at least one page. So if I'm writing a report, maybe I'll address from financial manager. From financial manager, debt to the board, to board of director. Is not stable today. Reassessing the performance of the company. I don't know if you can manage it. My internet is on and off. To task was the performance of the company for the years. The years 2020 and 2019. Also, or 2020 in comparison to industrial ratio. So the performance was assessed using a ratio analysis. The performance was assessed using ratio analysis. And below is the detailed information. Detailed information from the analysis. Simple introduction. Then profitability. That is the first part. I'm assessing profitability. Then say the profitability was measured using these ratios, and it was found like this and this. Then I go to this, paragraph, 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 paragraph. That's how you're going to write a report explaining. You cannot say that you compute gross profit margin, you write a simple sentence. You compute the net profit margin, you write, no, in that case, you will never finish the question. First, do all the calculations. Then after doing all the calculations, write a simple report about that performance. I don't know if you have the question. I've already exceeded the time that I had allocated to this part. The microphones are open. It's not the same. Profit attributable to ordinary shareholders, you get the profit after tax minus preference dividends. Profit after tax minus preference dividends. Then you can get the profit attributable to ordinary shareholders. So the microphone is open. You can ask a question on this part. Then, as I said, the industrial ratios will be given. The question will give you the industrial ratio. You are not the one to calculate. The question will show you what other companies are getting in the industry. I hope I'm clear on that. Any other question? Can we move on? Can we move on? If you don't have a question, we can go on to other part.
Yes, move on.
What else do we use to assess? No, the other method, but you can use comparative analysis, but those ones are not examined. Comparative analysis, common size analysis, those ones are not part of here. So that is the first part we have talked about. Another part I want us to look at are the sources of finance. You can just mention them because I know these ones, you know them. Sources of finance. Sources of finance. So sources of finance can be classified into two categories. We have the short-term sources, but we also have the long-term sources. When it comes to sources of finance, we classify them into two categories. No, these ones you can do because this is apart applying these formulas and calculating the ratios. I don't think it is in too much necessary. It's about applying the formulas and calculating the ratios. Probably if we get time, we can look at an exercise. But let's first finish what we are supposed to finish. So we can say that these are classified into two. That is the short-term sources and the longer-term sources. The short-term sources of finance and the longer-term sources of finance. When it comes to the short-term sources, so these are sources of finance that are below 5 years. In finance, unlike in accounting, but in finance, any source that is below 5 years, we recognize it as a short-term source. As long as a source is going to be used in a period that is below 5 years, that one is classified as a short-term source of finance. So they include we have bank overdraft, bank overdraft. So bank overdraft, it is when the bank allows the business to over withdraw. That's what called a bank overdraft. The account is over withdrawn. So you withdraw than the money you have on the account. So what is the advantage? Advantage here, I can give at least two advantages. Number one, it is easy to get. Bank overdraft is very easy to get as compared to the loan. Another advantage, it does not require security. Does not require a collateral. You don't need a collateral to get a bank overdraft, and you can finance working capital. It can be used to finance working capital. These are some of the advantages of how to on using a bank overdraft. Then disadvantage, it is expensive compared to a loan. It is expensive compared to a loan. If you compare a loan and a bank overdraft is much costly when you look at these two. Number two, it doesn't have a fixed payment period. It does not have a fixed payment So if you're using a bank overdraft, you don't have a fixed payment period. Anytime the money is put on the account, the money can be taken away from your account. So there is no fixed payment period. So those are the advantage and the disadvantage of financing using a bank overdraft. Then number 2, we have the short-term loans. So short-term loans are those loans that are below 5 years. Are those loans which are below 5 years. Loans which are below 5 years are what we refer as the short-term loans. Advantage: it is you are just changing these ones of the bank overdraft. Advantages: we talk of the disadvantage of bank overdraft. Advantages or disadvantage: you talk of the advantage of bank overdraft. So this one you can be able to change the language. You just twist the language and then it becomes advantage and disadvantage there. So another type, this was B. Another type here is trade credit. Trade credit, it is when the company purchases on credit. It is when the company or the firm purchases on credit. If the firm purchases on credit, then that is one way to finance its operations. Advantages: it's almost the same as up there. It is easy to get. It is easy to get. It doesn't require collateral. Doesn't require a collateral. Disadvantage: disadvantages: it is expensive compared to cash. It is expensive compared to cash purchase. There's foregoing of cash, foregoing the cash discounts. If you purchase on credit, you're going to forego these cash discounts. And if you compare cash purchase and credit purchase, you find that there is always a cost an extra cost when you purchase on credit. Then you also have a D is leasing, both operating lease. It can be an operating lease, it can be a finance lease, financing lease, and it can be sell and lease back. So these are ways to finance. You can go for an operating, you can go for financing lease, you can go for what you call sell and lease back. You sell the asset, and after selling the asset, you lease it back. So it's also a way to finance the operations of the business. So what are the advantages here? Can talk about one or two, because these are almost the same advantages. A firm can acquire an entity without affecting its cash flow. A firm can acquire an asset without affecting its cash flows. A firm can acquire an asset without affecting its cash flows. The disadvantage, there is an extra interest paid on lease. There is an extra interest cost which is paid on lease. So if you finance using a lease, you'll always have an extra interest cost that you are going to pay on that particular lease. Then another one we can talk about, which we also talked about, is that is going to be our last one. Under the short-term sources, we have what we call factoring. Factoring. I think we talked about this one in working capital. So factoring, that's when we said you employ an outsider. Factoring and the invoice discounting, you can put them into one. And the invoice discounting. We talked about this in a working capital management, and we said that factoring, that's when you employ an outside company to manage the receivables. And we said that one of the advantage of factoring is that the factor company always pay an advance payment. So that advance payment can be used as a source of finance. So it is when an outside company is employed to manage the receivable ledger. That's what we call a factoring. An outside company is employed to manage the receivable ledger. And this factor company, as we discussed in working capital, will always pay an advance payment on the receivables. So it is the advance payment that is a source of finance. So here, the advantages, the company can finance its, the company can finance its sales growth using the internal sources. You can finance the sales growth using internal sources. You are not going to borrow from others. But if you look at that disadvantage, there is a cost on the money given. If you look at the disadvantages, there is an extra cost on the money given. So if they give you, as we saw in working capital, there is always a charge that you are supposed to pay as an interest on the money that this company have given you, which is a cost. Then another, we can add the long-term sources. Long-term sources of finance. Remember, we are saying that you can finance either using long-term sources or you can finance using the short-term sources. Now, if you talk of the long-term sources, number one, we have a debt financing. That is borrowing either from the financial institutions or borrowing from the public. So it involves either borrowing from financial institutions or borrowing from the public. That is the debt financing. You can borrow from financial institutions or you can borrow from the public. So types of debts, we talked about them, I think, during cost of capital. Types of debts, I can just refer you. We said we have a floated debt, which we said it is a debt that is traded in the stock market. I'm just reminding you this because we talked about them when we are discussing cost of capital. Here we talked about the redeemable debt. Hope you remember. Redeemable debt. We talked of the irredeemable debt. Irredeemable debt. And we also talked about the convertible debt. I think these debts, we talked about them in the cost of capital. They are well defined. I can just refer you to cost of where we wrote our notes in the cost of capital. You'll find this definition of these debts. So another category, probably what we did not talk about, is what we call a zero coupon debt. A zero coupon debt, and zero coupon debts are those debts which are issued without a coupon rate. This is a debt which is issued without a coupon rate. Then the question will be, how will the owner of this debt gain, or what is the benefit of someone investing in a debt which has no coupon rate? The investor will only gain if the market price of this debt goes up.
Is it coupon debt or coupon rate?
Zero coupon debt or bond. I wrote it, debt Tariq.
Okay.
Yeah. I was explaining that the investor of this debt will only gain if the debt is sold, if the market price goes up. If the market price goes below, the investor will lose on this debt. So another thing that we can talk about here is what we call a deep discount. A deep discount debt. Deep discount debt, it is a debt that is sold below its market price. It is just like a sweetener. You are attracting investors to buy your debt. Then the debt is issued below the market price. That's what we call a zero coupon. Sorry, a deep discount debt. I said a zero coupon, it is a debt which has no coupon rate. There is no interest rate on that debt. So the owner only gain if the price of the debt goes up. So the only benefit is the capital gain. Is a debt which is issued below its market price. So the debt is issued below its market price. Then we call it a deep discount debt. So these are different types of debts. Another thing before we look at, I think we also talked about it, is the conversion value. Conversion value of the debt, or conversion value. And you can say that is the value at which the debt is converted into shares. So if you have a convertible debt has got an option to be converted into shares. So the conversion value is that value at which the debt can be converted into shares. That's what we refer to as the conversion value. And to get the conversion value, will be equal to the conversion price, or what we call the exercise price, conversion, or what we call exercise price times the conversion ratio. The conversion ratio is the number of shares that can be converted per date. When we say conversion ratio, it is the number of shares which can be converted per date. How many shares are you going to convert in each date? Then that is going to give you a conversion ratio. If each date you are getting 2 shares, then it will be 1 to 2. Or if each date you are getting 3 shares, then the conversion ratio will be 1 to 3. Then another thing we can talk about is what we call the conversion premium. And the conversion premium is the difference between the market price and the conversion value. The difference between the market price of the debt and the conversion value is what we call a conversion premium. Whenever the conversion premium is positive, don't convert. If the conversion premium is negative, then you can convert. So conversion premium is equal to market price or market value minus conversion value. And I've said that if the conversion premium is positive, don't convert. It means that your market price is above the conversion value. But if the conversion premium is negative, then you should convert. It indicates that the conversion value is above the market price. So that is what we can talk about here. So what are the benefits of financing using debt? Benefits of financing using debts. What can be the benefits for business to finance using debt? Number one, the debt holders are not engaged. Debt holders don't interfere with the management. The debt holders, they are not going to interfere with the management of the business or with the management of the firm, because they are out, they don't participate in the annual general meeting. So they are outside. They are not interfering how the business is managed. Number two, the cost of debt is cheaper compared to the cost of equity. If you compare the two costs as we saw in our previous part, the cost of debt is a bit cheaper as compared to the cost equity. Number 3, the interest on debt is tax allowable. The interest you pay on debt is tax allowable, and others you can look at them. Then what are the disadvantages of financing using a debt? What is the disadvantage of financing a business using a debt? Number 1, the interest on the debt is a fixed interest payment. You have a fixed interest payment. Whether the business has generated the profit or not, you are supposed to pay the interest on the debt. Another one we can talk about it increases the gearing level, the gearing level of the business. It increases the level of gearing of business, which increases the financial risks. If you are financing using a debt, you are increasing the level of gearing, but as you are increasing the level of gearing, you are also increases the financial risks. We also have debt covenants, which also limit. We have the debt covenants. So you may find that the debt holder has put some restriction on what the business should do. This is what called the debt covenant. So they can put restrictions, either don't give dividends, don't hire these words. So these are also limitations to financing a debt. And also, if the stability of the cash flows is not, if they don't have stability in the cash flows, then it's not good to finance using a debt, because it's going to have an effect on the cash flows when the debt has to be paid. So those are some of the disadvantages of financing using a debt. Another one we can talk about is ordinary share capital. Ordinary share capital. Ordinary share capital these are shares that give right to ownership. These are shares which gives right to ownership. So these ordinary shareholders, they are the owners of the business, and therefore they are involved in the day-to-day management of the business, because they are part of the owners of the business. So what is the advantages of financing using ordinary share capital? Like any other sources, it is a long-term source of finance. Thus, can be used. It can be used to finance long-term investment. Ordinary share capital is a long-term source of finance. Therefore, it can be used to finance longer-term investment. Even on debt, you can put even that point can work on the debt. Number two, it has no fixed payments. It has no fixed payments. So when you are, because when you have your financing using equity ordinary share, you can only pay dividend, and the dividends on ordinary share capital is not fixed. You can only pay if the company has generated a profit or it has no investment opportunities. That's when you can pay dividends. The capital is not repaid back. The capital is not repaid back. Unlike a loan, a debt, when you finance using a debt, you have to pay back the money. But for shares, the money is not paid back until the business is wound out. So those are some of the advantages of financing using ordinary shares. What are the disadvantages? Disadvantages: they interfere with the management of the business. Because they are the owners, they attend the annual general meeting, they can interfere with the management of the business. The cost of equity is higher than the cost of debt. The cost of equity is higher than the cost of debt. If you compare the two costs, you'll find that the cost of equity capital is higher than the cost of debt. So those are some of the disadvantages of financing using equity ordinary share. So how do you raise capital? Raising capital, ordinary share capital. Raising ordinary share capital. Now, raising ordinary share capital, there are three ways under which the company can sell shares. You can sell shares under IPO, they can sell shares under private placement, or they can sell shares under right issue. Those are the three ways under which the company can raise the so under the initial public offering, the company raised capital by issuing shares or by selling shares to the general public. So under this, the company raised capital by selling shares to the general public through the capital market. That is the initial public offering. The company will invite the different shareholders, every individual will be invited to come and subscribe to the company shares. Of course, the shares are sold to underwriters, but the underwriters are the ones that sell the shares to the general public. So that is the initial public offering. Number two, under here, it's number one. Number two is what we call private placement. Private placement, the company sells shares to few listed or to few investors or to few institutional investors or other investors. That is the private placement. So under this, the company sells shares to few investors or few selected investors. In this case, the company is not going to call the general public to come and buy the shares. Only selected investors will be called or will be invited to buy the shares. That is what we call a private placement. Then number three is what we call a right issue. And under right issue, in the right issue, the company sells shares to the existing shareholders. So under this, the shares are sold to the existing shareholders. So it is the existing shareholders whom they are going to call to come and subscribe or to buy the shares of the company. So in this case, what the company is going to sell is the right for the shareholders to buy shares. And when they are selling the right, it is always one share, one right. One share, one right. So the number of shares you have are the number of rights that you have to buy the shares. But when they are issuing, they can say maybe if you have 2 shares, you will be getting maybe 1 share. Private placement it depends on where the company want to say, because in this case what you are limiting are the costs of inviting the general public. So you just select those few institutional investors whom you know that they buy shares, and call them and ask if they want to buy the shares. That is the private placement. So that is now. And also talk about what called the theoretical right price, what we abbreviate as TERP. The theoretical right price. Now, if a company has issued shares, we expect that after issuing the shares, the market price of the share is going to go down. If it has issued the right issue, we expect that the market price of the share is going to go down. So the price of the share after a right issue has been issued, then that's what we call the theoretical ex-right price. So it is the price of the share after the right issue has expired. That's what we call the theoretical ex-right price. The price of the share after the right issue has been issued or the right issue has by the number of shares in issue. So when you want to get the theoretical X price, you are going to get the value of the shares in today the network is really the poorest of the days. Every time the network goes, made the right issue of 2 shares for every 4 shares held. In the company at 200 francs per share. Current market price So let's look at this. Company X made the right issue of 2 shares for every 4 shares held in the company at 200 francs per share. The current market price of the share is 350 per share. Then we are required to compute the theoretical ex-right price and the value of the right, and also to advise Mr. Kenny, who owns 300 shares, on the best option to maximize his wealth. So let's say we are saying, when we are doing this, we have the item here, we have the market price, then we have the number, then we have the value. So existing shares, the company is issuing 2 right issue for every 4. It means the existing shares are 4. The existing shares are 4, and the current market price of the existing share is 350. Then right issue is making a right issue of 2, and the current market price is 200. So what is the value here? I get the number of shares, the market price times the number of shares. So the number of shares is here. So as we said, our TAP is equal to the value of the shares in the issue. The value of the shares in the issue here is 1,800 divided by the number of shares. So in this case, we are going to get this divided by this. So this is going to be the theoretical ex-right price. The value of the share divided by the number of shares in issue. Okay. Now, how to get the value of the right? Value of the right. The value of the right is equal to TAP minus the right issue price. You're going to get TAP minus the right issue price. So this is going to be, our TAP is 300 minus 200, which gives us 100. That is the value of the right. That if you don't want to exercise, then you can sell your right at 100. Now, we are supposed to advise Kenny on the best option. Advise to Kenny on the best option. Now, when we are providing the advice here, we are going to look at the 3 key scenario or 2 scenario. That's the most ones. Scenario number 1, Kenny exercises the right and acquire the shares. Suppose Kenny exercises the right and acquire the shares. If he exercises the right and acquire the shares, how many shares will he get? I said the value of the right means that in case you don't want to exercise your right, you can sell your right to another individual at 100. If you don't do anything, it means you are going to lose this money. Okay. Now, if you look at this one, the first option, we are saying Kenny is going to exercise the right and acquire the share. How many shares does Kenny have? So we shall have the existing shares, they are today is really bad, eh? Today is a bad day. These shares will be valued at the theoretical price. So this is the value of existing shares. Value of existing shares. So I'll have this times this. Now, what is going to be the value of right issue? Value of right issue. Now, how many shares is he going to get on right issue? Remember, is getting 2 shares for every 4. So in this case, we will get 2/4 times the 300. The 300,000. Then we multiply at 200. That will be the price. Sorry, we value them at 300. Sorry, at 300. So how many shares are we getting here? 2/4. That is 1/2. That is 150. This is going to be 150 times 300. Then we less what he has paid, less the cost of new shares. The cost of new shares will be 150 times the 200. 150 times 200. So that is going to be his worth. That is the worth in case he he exercises the right and buy the shares. Scenario number B, Ken exercises the right but sells the shares, but sells the right. He can accept to exercise.
Excuse me, where did we get the cost of new share? The 150.
Which one?
Cost of new share 150 is what?
The number of shares. The new
Okay.
share. The new shares that is getting. So it means you will have this. We also consider the value of the right. How many rights does he have? He will have 300,000 rights, and each right is going to be valued at 100. 300 rights at 100. This is going to be the wealth. Now, 150 was not assumed. Look here, is getting two new shares for every 5. So what is the new shares is going to get? The new shares is going to get will be 2 over 4 times 300, which is 2 over 4 times 300. So that is the shares that is getting. Why do you have to raise the value of the new shares? He has acquired these shares. He has acquired this. He has paid money to acquire. So if his wealth is like this, we need to less what he has paid to acquire the new shares, then to get the net wealth. Network is really bad today. Scenario number C. Kenny ignores everything. Suppose he ignores everything. He does not acquire the share, neither does he sell his right. What is going to be his wealth? You are only getting this. So the best option is to exercise and sell the right. So Ken should exercise and sell the right. I think that is how we can look at this. Then another thing we can talk about here, we are looking at is preference share capital as another source of finance. Preference share capital. This was this is ordinary share capital. We are looking at longer term sources of finance. We have looked at
Excuse me, sir.
Yes, please.
Why do we have to add the value of right yet on the scenario number B where Ken has to exercise the right but sell it? We add the value of right yet he's selling it, or I'm getting it wrong?
Yes. If he sells the right, he's going to get that money. He's not getting new shares, but he's going to get the money from the sale of the right.
And then how is it different from this scenario one in terms of the new shares?
In scenario one, your share is going to increase. For example, we had 340, sorry, we had 300. You are adding other new shares of 150. So you are becoming the new share. Your shares are going to become 450. So your number of shares are going to increase. But in scenario two, what makes an increase is the money you are selling from the right.
Thank you so much.
Okay. So let's look at these ones. So these are shares. These are shares that gives right to dividends. So these are not part of the owners, like a share, ordinary share capital, preference share capital are not part of the owners. So if you look at you can discuss the advantage here. Just talk about the disadvantage of ordinary shareholders. But advantage, like ordinary shareholders, they are also longer-term sources of finance. Longer-term sources of finance. So you can use them to finance longer-term investment because they are longer-term sources of finance. Advantage number two, they do not interfere. They do not interfere with management activities, because these shareholders, they don't attend annual general meeting. They are not part of the owners, so they are not interfering with the management of the business. If you look at the disadvantage, they also have a fixed dividend. They have a fixed dividends. Disturbing. I don't know if it's mine or even yours. Venture capital. Venture capital, these finances startup businesses which are neglected by other financial institutions or other financing companies. These finances startups which are neglected by other financial institutions. These are what called the venture capitalist. So what they do, these venture capitalists, they can ask the business to give them shares, to give them the management role, but they are once you have a very good idea, they can finance that idea. That's what we call the venture capital. Now, the advantage of this venture capital, others I think you can read them into the notes, and this part is very common. Advantages of venture capital. They finance business startups. That's number one. They finance business startups. The capital is not repaid back. The capital is not repaid back. So it's not a loan. And there is no interest charged. There is no interest charged. So these are some of the advantage. Disadvantage of venture capitalist. interfere with the management. They interfere with the management. Whatever you are doing, so they are going to interfere with the management. So another two, they can ask shares in the business. They can ask shares in the business as a condition to finance. They can ask you to give them shares, so they become also part of the owners in the business. Number three, everyone is facing the challenge of internet. So I was saying, one of the conditions of these venture capitalist is a business plan. You must provide a business plan. So you should know how to write a business plan, the content of a business plan, the market research, the financial part. I think those ones are also very important, because it is one of the conditions for these venture capitalists. They ask a business plan. At least you should have some knowledge on how to write a business plan. What are the content, the executive part? You come to the introduction, you come to the market research, financial plan, and other parts within the business plan. So at least you should have some small knowledge on a business plan. So the last one, about here is sources of finance. So these are sources from the business. That's what we call the internal sources of finance. So I think